G'day traders, in this module we will be going over first red day and first green day trade setups. One of my favorite trade setups is the first red day, and again I emphasize the importance of having go-to trading setups that show up over and over again. The first red day can be a very lucrative opportunity, and the thesis behind it is that we've got initially the pump up, and then a day we can have a green day, a pump up day where they pump the market up. It looks like a trend day. Next day may even just trade sideways. The next day could be a day that closes down, or we can get a first green day, a big day, a pump up day, and then the next day closes down as our first red day. The first red day is a trade signal. That day is a trade signal. The next day, what we're looking for is high of day selling opportunities. Now, my main focus is in the US session, but often these trades will initiate in London. They may break down to the low of the day or towards the low of the session, but come back up inside of that peak formation into the high of the day and for a sell off in the US session for the larger move. So sometimes you can get a first entry in London, and we'll talk about that because some of those will perhaps start to exhaust towards the low of the session and then auction back up in the gap towards the US open, US 12 candle window open, before breaking down. And sometimes they'll break down and pop up into the US open down low and continue down through the 50 pip target in the US session. So we'll look at examples of that. First red day. So I've put in here a weekly high or low can be broken. So we're starting the new week on a Monday, and it doesn't always have to be that way, but often you'll find some of the bigger moves happen when they break a weekly level. So they might break to the high side first, Monday, Tuesday, and Wednesday could be a first red day, or Monday, Tuesday could be a first red day. They can pop it up again on the trading day, and we can get our three peaks or a high of day sell inside of that first red day for a large move back inside of the previous week's range. Not always, but those are some examples we will look at. So ideally, we want a pump up day first. We don't just want a green day and a red day. We want a day that pumps up first, bringing volume up high, and then a day that sort of struggles and fades and creeps its way down slowly or sideways and closes below the open for a first red day. That's what's critical. We want to have volume pushed up high or trapped up high, and then people chasing that trade or that trend the next day. So then we want our down day, and sometimes it will be a very subtle closing down day, which is where the market doesn't get any other triggers on longer time frames, so they think the trend is still up and that first red day has volume trapped. They put a peak formation in, they take it back up to that high of day, and the short trade is in place. The next trading day, I am looking for high of day short trades. We can see them in any session. Sometimes we get a first red day on a day 3, and it'll blow off into the open of Asia down through the low of the day or the week. It may pull back, but it can start in Asia sometimes. We may see a pop-up in Asia, come down, and then bring it back up to the high of Asia for the short trade at the high of the day in London that takes out the low of the day. We can see them in any session, and again, we will look at examples of all of these. Closing, my charts are based on New York time. The closing time is 5 p.m. New York time. So it really doesn't matter what chart you use. If the setup is there, the setup is there. My charts are revolving around Asia, London, New York completes the day. The day closes at 5 p.m. New York, whether that's wintertime or summertime, it's 5 p.m. in New York. Currencies will open right away on the rollover, but we're not looking to get in. We're looking during the 12 candle windows, the Asia session, London or New York, very specifically. And we'll hammer out a lot of examples of these. And your chart closing time isn't really critical, but I use New York closing charts. So the next day we're looking for high of the day short trades, Asia, London, New York. The basic setup targets the high of the week to the low of the week. Sometimes it'll be the high of the week to the low of the day. Other times it will be inside of the high of the week back to the low of the day, or we can go from inside or near the high of the week all the way to the low of the week. Now, in the majority of cases, most of these will be after news, so I don't trade in front of the news. So if we have a first red day and the trade starts to take off and then there's a news candle, I would trade that news candle on the first bounce trade, which is a different setup based on waiting for the news to trade first. That's just my choice. Sometimes traders can get into the market early and they can pin right up through your entry before resuming the downward movement. So even though you may have a stop in place, there could be slippage. You can get wiped out. Generally, it's not worth the risk. I wait for after the news, major red news, or if I'm in the trade and it's going, I may have my 50 pips before the news candle, but I'll close the trade before the news comes out. This setup gives us great risk reward because we're selling near or at the high of the day, and we're targeting the low of the day, the low of the week, the low of the session. So we're usually typically the minimum profit target on these trades will be 50 pips. We'll talk about a couple of different examples where if the market has not completed that 50 pip distance, how to recognize why to cut the trade and lock in whatever profits you do have. So we're going to be using 5-minute charts. I've tried to make this as simple as possible so that there's not a lot of analysis paralysis. Entry will be an engulfment candle or a pin hammer at the high of the day or inside of the high of the day. We're going to use a 20 EMA average so that traders gain less subjectivity, and the close, your entry will be inside of that moving average. So we don't want to get into the market until we're inside of the 20 EMA. That just makes things easier for traders to have less analysis paralysis and to gain that confirmation bias or locking in that so that there's not fear or FOMO of getting in. We'll use that as our confirming entry, the first close back inside. After we have our topping pattern, which we'll look at different examples of those, our stop loss will be at the high of our entry candle or at that peak formation, which we'll talk about. Typically, there'll be 15 pips on the currencies, occasionally maybe a bit more, but roughly in that 15 pip area. If it's another instrument, gold, oil, an index, obviously they can be larger, and we'll talk about some specific examples of that also. Again, initially our profit target will be 50 pips. Some of these trades are obviously going to give quite a bit more, but I would suggest just starting off sticking to some basic pairs and getting in the process of recognizing what a textbook perfect first red day setup looks like. We're going to go through quite a few examples to make that crystal clear. This is a very lucrative, high probability trade setup opportunity that I use quite frequently. So again, we're using the 5-minute charts to enter the trade, but we're going to use 15-minute charts just as our general chart template to get rid of the noise and just have a clear picture of our 2-3 day setup. And that just makes things a little bit easier. So just to hammer home also, we are not looking to counter trend a strong market. We are looking for setups on a broken market, one that's already broken down and then pumped up, so we could have a market that's in a downward cycle on the daily, during the week itself, and then we can get a pump up day, a first red day, and then a sell off day. But we're not looking to get in front of a trending market and just sell off the first downward close. Those are the markets we don't want to sell into. Now, occasionally you are going to get an ideal setup, but ideally the best basic setups are the ones that are going to be a pump up. You can get a pump up, a first red day, or a little bit of follow through, a weaker day, and then a first red day, and then a sell off day that goes back to the low of the week or back through the low of the week. Sometimes we'll get a first red day that gives a trade that doesn't quite go as far as we expect, but the following day trades back up and into the peak formations or inside of peak formations and rolls over for a larger move. So we'll talk about second, first red day trade opportunities as well. Ideally, the first red day setup, we're going to have a consolidation heading into the close of the session. What ideally I want to see, for me, being in the Northern Hemisphere, is a market that builds up over the day towards the top of that consolidation to give me my entry up high for the big explosive first red day opportunity. That to me is the ideal best first red day trade setup. Now, there are going to be other cases where we can get a move up in Asia. We can get a large move down in Asia that when I come to the screen later, Europe, London may have a continuation, but when I come to the screen, the opportunity may be gone. Now, the other scenario is that we can also have a market that trades in the, I'll just change that, in the London session for a large move down, and I get the low-hanging fruit trade in the US session that finishes off the move. But just to repeat, the ideal candidate, the best candidate, will be one that builds up over the course of the day, 3 sessions, and we get a large capitulation that will often now give us our measured move distance of at least 1 full expansion, or maybe 2 or 3, but hopefully 2. If it's a really good first red day, we'll get at least a 2 times expansion of that high-low rectangle, which typically will be sort of in the area of 100 pips, depending on the instrument. Now, gold and oil may be more, but when it's a really well-structured rectangle on a first red day setup that gives 3 sessions and builds up volume, we can get an explosive, all-in, perfect first red day trade setup. This is a great example of first red day sell, and we'll just put this red line as our Friday, Monday. I'm going to be starting all of these on the beginning of the week, which is Monday, so you can come to the screen each week and just be trading whatever setups that you have, but first red day is a setup that I look for each week. I just scroll through the major pairs. I look through the Swiss franc, Canadian dollar, Japanese yen. They all move very similar. And then I group the pound, the euro. I don't really look at Aussie dollar or New Zealand. They don't tend to move as much, but oil, gold, NASDAQ, S&P, and Dow. And then, of course, the pound yen, euro yen. So in my basket of instruments, there's enough. It takes you literally a few minutes to scroll through to look for certain setups. So this pair, on our Monday, we get our pump up. So this is a market that's been moving strongly in the upward direction. And again, I'm just randomly going to go through these in terms of identifying the setups. I'm not going to tell you that I cherry-picked any particular instrument or anything like that. I'm just going to scroll through and we'll look at different pairs. It shows up all over the place, but we have a breakout of a weekly level. And Monday, as we have talked about, is a day that when it's establishing the opening range for the week, I don't typically, if it's going up, then I expect that the market's going to continue to go up. And so I don't often counter trend, but we have a day Monday that's pumped up and then came down and then closed up near the high again. So there's our first sign that the market, we've got a pump up day now. That's our day 1. The market pumps up and goes higher the next day and ends up closing below the open. So we have our first red day. Now, the market closes below the open, and the next day what we'll be looking for is a high of the day sell setup. So depending on where you're trading from, whether that be the Asian session, the London session, or like me, you go to bed at night, you wake up in New York and you go, oh, I missed the first red day trade. But lo and behold, the market still came back up to the high of the day. Now for traders who were trading in the Asian session, again, we're going to be talking about peak formations going up. The market goes up and then breaks down at the high of the day into the open of the London session. So now we go to our 5-minute chart. So if you were in the Asian session, you did not have a sell setup possibly until later in the session. But traders who were trading the London session had an opportunity in that first hour of the Europe 12 candle window between 9 and 10 to position themselves early, again with a stop above the high. So this left shoulder is the last high that has held, where they traded up into that in Asia before coming down and pinning and popping up. Once this pin comes down, which is just prior to the Europe window, this pop-up is where we now can comfortably enter the market back inside of the 20 EMA. So again, we have our 5-minute chart. We have our high of the session opportunity. So we're inside of the high of the day. In this particular case, the market has not traded back to the high of the day. It closes back inside of our 20 EMA on our 5-minute chart. And again, all these screenshots are available in your notes, so don't stress. So we have an entry, first entry, roughly around 98.15 area. And our stop loss can comfortably be placed, a maximum of 15 pips above the high. So again, this is 15, 25 roughly to 30, puts our stop above that range. And again, our thesis is that this market now should go our 50 pips. So if you waited and did not enter until this engulfment after the London Open, your entry was at 06, and the same rules apply. So again, the same rules apply. If you take the engulfment, your stop loss will be placed above that candle. So again, the engulfment entry closes at 06. The high of that engulfment candle is at 16. It still keeps us in that 10 to 15 pip range, but again, the momentum of this trade should accelerate now that we're in this move. So if we got in at 06 and we put a target down at 97.56 for the second entry, just to see where that takes us, we'll just have a look. It hits our 50 pip target even on the second entry. So coming back, we'll just look back at this. We have our pump up day, our follow through day that puts in a peak formation before breaking down, and you'll notice again just how it shorts through that ramped up volume and then goes sideways. What that means on first red day is that all that volume above there is trapped. And that's the whole thesis behind first red day, is they pump up the market, they get traders following through on the second day. Sometimes it can be, first red day might happen on the second day and it may already be down, but we get the volume trapped up high. We get our 5-minute, we then go to our 5-minute chart. We didn't get the sell high signal in the Asian session till later. If traders did take that, the difference is that you have to now sit in this trade, and we'll look at some examples of one that does go off in Asia, because this is not a trade setup. They're just now creeping trend up. They put in a lower low. That establishes now our anchor point for the pump up into that peak formation. We get our little entry, pump up, right at the Europe open window, heading into the open of London session. We get our close back inside of the 20. We get a second entry with an engulfment at the London equity market open. Both of those trades followed through to hit the 50 pip target. If this did not get down, or if it pinned to your level without taking you out, I would in most cases close the trade. Once it goes that far, if it pins and it's creeping down into that low, as soon as I see a pin, if for example, if the pin had gone just sort of there, not even taking us out with our spread, I would close the trade. But in this particular case, it hit our target at 56, which was our worst case entry, and we have our first red day 50 pip trade. Here's an example of a Friday, Monday. We get a pump up day on Friday. The market goes vertical. and closes up near the high. The next day, on our beginning of our week, we get a day that trades down for the bulk of the entire day and closes as a first red day. So we get our pump up day and our first red day. That's our trigger day. Then we go to our 5-minute chart. I'll just mark that off as our first red day. First red day that closes down low. We then put our 20 EMA chart on there, on our moving average on there. And again, this is just to filter out, to keep you out of poor quality setups, and again to remove the analysis paralysis. When you know, after a while you won't even need this, but what this does is it makes the decision process easier, so that I can give you some simple rules to follow to keep you safe and to give you the confidence to be able to get into the market. So we have our low of the day on our first red day. We're looking for a high of the day, high of the session sell opportunity. We don't get that in Asia. Market creeps higher, creeps higher, creeps higher. And towards the end of the Asian window, just prior to our Europe open, still pushing higher. So basically we're in a consolidation. Then we come to our US window and we think, oh, maybe we're not going to get our first red day. But this is where they use the entire day to build volume and order flow. You notice the previous day was a large down day. We are in a first red day trade setup. We are looking at 3 peaks. This is a 3-session setup. Asia, London, into the US Open. They pop up at the New York Open into that peak formation. Some traders will get in right away. Again, entering the trade on that first close back inside. So not the first collapse, but once we go back up into that peak formation after the New York equity market opens, some traders are going to enter the market right away. We want to see this peak formation. Then heading into the New York Open, they pin up into that peak formation and break down. Again, some traders are going to get into the market at that area. Stop goes above the pin. Simple as that. We're in the market. If traders are patient and they wait till after 9:30 New York, which again, we see this little breakdown which breaks structure on the inside, the lower low, they pop up one more time before pulling back inside. So as we saw in the Swiss franc, sometimes there'll be traders that get in early and aggressively. There'll be other traders who are just a little bit more cautious and want to wait. And we see that second breakdown and then the entry after the New York equity market opens. Again, a 1-bar stop. Our target will be 50 pips on this trade. And our second trade had no problems at all hitting that 50 pip target either. Now, some traders may take the full amount off and other traders may choose to hold on to a trail or to see how far this move may go. And again, they could just put another profit target in or hold that and close it. If you hold it into the rollover, obviously you're going to pay rollover fees. But just summarizing this trade again, we had our pump up day on the Friday. Pumped it up vertical. We get our first red day on the Monday. We get our 3 sessions set up, three levels of rise for the sell-off in the US window for an easy 50 pip trade. First red day. Again, here's an example where we get our vertical pump up on a Thursday. Market closes up near the high, so we have our pump candle, our pump day. Market goes vertical. Just draw a little level there. The next day, that market collapses down on the Friday from the high of the day. So again, different trade setup. But if we come to the screen on Monday morning and we see our first red day, the thesis again, we go back and we set up for our first red day trade opportunity. Market auctions higher in Asia, continues to hold above our 20 EMA on the 5-minute, continues to auction higher into the US window. We head into the US window with a high of the day in place heading into the New York Open. The market then closes underneath of our 20 EMA. We get our close back inside of the 20 EMA after the peak formation micro M structure. So they go up and hit the high, they come back down and close inside. Fill is roughly around 56, 57. Puts our target down at 2307. Now, it doesn't get there. But as I mentioned, we get to the low of the London session, the low of the Asian session, and the market starts to go sideways at the low without following through. As we saw in the other trades, they went vertically through. This is an example where I would just cut the trade. So this trade gave roughly in the area of 25 pips, which is again just what that trade gave on the day. An easy, low stress, easy first red day trade setup. Just an example of where it didn't completely go all the way, and we could see a second day follow through in the next day. If we don't get that completed move, I lock in the profits, and I'll continue to watch that in the session that I'm trading. So in this particular case, London traders may have had the opportunity for the completion of that move. Again, that range is pretty tight, but a 25 pip blow off, which is the continuation of that first red day trade. So once this market comes back inside, if you were holding on to this, following through on that first red day trade, you'd want to either be locking in the money. We took out the low of our pump day, our day one, and the first red day that gave us the 25 pips. That trade is still in process, but once it blows off through the low and starts to reverse, we want to be cutting that trade if we haven't already locked in pips. But our first red day trade, we had the pump day, we had the first red day. We go to our 5-minute chart. We allow the market to do its 3 peak pattern, our high of day setup. That was in the US session again. The close is back inside of the 20 EMA for a vertical blow off, 25 pips through the low of the day in the session. Here's an example on the Japanese yen. We have a day that's pumped up into the close. Obviously, there was news earlier in the day in the U.S. session. We had a pump up into the close, and the next day closes as a first red day. So we go to our 5-minute chart, and we put our 20 EMA on there. It's an example of where the Asian session gave a vertical move and a micro M structure before closing back inside of our 20 EMA. Now, the market then comes back inside of our 20 EMA, and traders can get in anywhere once it's back inside, but we see this bear pin. We'll just call that a midpoint entry back inside of the high of that consolidation that it broke out of, somewhere in that 89 to 90 range. Now, we've put a 50 pip target down at 39, and the market breaks, creeping trend sort of, and then eventually breaks down and takes out the low of this swing low over that length of time. So we're into the trade at 9:25 at night, New York time. And by 12:25, the market has yet to fall through and hit our target. So we're in the area of a 25 pip move. The market has taken that long to get there. I would be closing the trade. So once it breaks the low of that low of the day, I would be at break even. If we were monitoring that trade and it was taking that long, I would be exiting the trade with a 25 pip profit target. So somewhere in the area of 60, 64, somewhere in there. The market didn't quite get down there, but as soon as we got down to this low, you could even adjust your take profit level somewhere inside of maybe those lower bodies. Often the wick, just that extreme. If it's taking that long, I would target the low of the bodies or just close the trade altogether. But an Asian session, first red day trade. However, if we came later and we were trading the Europe-London session, the market rolled over into the open of the US 12 candle window for a blow-off move, again a 25 pip blow-off at the open of the session. Entry again is inside of the 20 EMA. We've had a little vertical pop up from the low of day. The market rolls over back inside of the 20 and goes vertical down in 3 pushes. Again, one push 2 pushes. We're at a 25 pip profit target. We get these pins. We're into the open. I'd be closing that trade. Just emphasizing a low stress, high probability, or asymmetrical risk reward trade. So this didn't pan out at the high of the day. It blows off in Asia and then in London. So obviously in the US, we're not looking for the first red day trade opportunity, but we have a tight risk, 10 to 15 pips on both trades. First trade gives us our 25. If you held on to it, you got your 50. Pretty close to your 50 pips. Not quite, but you'd get 40. And that's an example of where time over time decay, I'd just be locking in the profits and getting off the screen. Not all instruments are going to move the same. Sometimes the yen may not move as much as the pound or gold or whatever that is. But if the setup is there, I will hit the trade. Look at the US pairs, US CAD, US yen, and US Swiss as a basket themselves, and I'll look to target just one of those 3, whatever I see is the best setup out of the 3 pairs. So they'll often maybe show the same setup, and we'll look at an example of that right now. And I'll look to just pick one of the 3 and trade that pair, and if one moves further or doesn't move as far or whatever, I don't really care. I just try to execute the trade, lock in the money, and get off the screen. So we have our pump up day on Monday, our first green day, a big pump on the Monday, breaks the high of the week, closes on day 2, Tuesday, as our first red day. Whenever I see a nice clean chart like that, I will draw my consolidation highs and lows. Again, that just gives me a nice thesis. If I'm coming in the US session, that gives me a nice thesis for, I usually do this at nighttime. I draw the consolidations of high lows and before I go to bed. And then I like to see how that's set up when I get up in the morning, because if it's set up properly, as we can see today we get a perfect textbook first red day blow off trade. We get our 5-minute chart. We put our 20 EMA on the chart. As I get closer to the window, the market, if I come later, has already started to move. That's okay. I get in. I'll get in that first hour. If I'm at the screen, I'll get in somewhere prior to the US 12 candle window. But generally speaking, as I say over and over again, I will just get into the market. Because I have my consolidation, I'm inside the 20 EMA, the trade is already in progress. So if I'm looking for a pop-up, you may not get that, but I'll get into the market. I'll put my initial stop in, which again will go above the high. So in this particular case, we're looking at about a 20 pip stop. No problems at all hitting our 50 pip target, but in this particular situation, when we have a rectangle, I will take often 2 times the distance of that high-low as a potential profit target. So our consolidation high-low is going to be more than 50 pips profit target. This is the perfect ideal first red day candidate for a large vertical move. Now it blew through our 2 times expansions, and in this type of situation, this is no problem at all holding on to a trailer, taking the bulk of the trade off, locking in profits, and holding onto a trailer for a potential 3rd expansion of that range. So again, this is just taking the high and low roughly of this distance. We can take 150 down to 08, so it's about a 40 pip box. So we could be targeting 80 pips from the low of that box. If we put that on there, we'll go at, just say that's at 39, 40.10. We'll call it 40.10. We can look at our Swiss franc. We have a Monday that breaks out of a weekly high. Takes out the high of the week and pumps up and closes as a green day, big green day. Our Tuesday comes back inside and closes as a first red day. Again, first red day on day 2, Tuesday. Similar to the Japanese yen, we can draw our consolidation, just putting in our highs and lows and heading into the close. So the day's closing, we just draw the high and the low across. It's first red day. I want to see how that sets up the next day when I come to the screen. This is a good example where traders may have tried to chase this move at the end of the Asian window, and it starts to go through and short trade this. So if they follow this through, they've got a bit of FOMO, they don't want to miss the trade, they get in, the market starts to fall through. Once it breaks down, I should be at break even if you were in that trade. Now again, I'm going to emphasize this is not the entry, but if somebody misjudged this and they thought that was an entry because we had the lower consolidation, they get into the market towards the end of that Asian window. Once it breaks down like that, I would be at break even. So what we want to see is a market that either trades back and forth as we saw on the yen, back up to the high and breaks down, or does a peak formation and breaks down back inside of the EMA. But coming back to our timing window, if we come back for the US session, we see this breakdown as our anchor point now for our pump and dump heading into the US 12 candle window. So again, this is an example of where the market started to move prior to the US session. If you got the better fill just heading in from the gap, if you were there and you had the entry, you're still looking at a 15 pip stop. If you had the later entry because you're just coming to the window for the US session, you notice the trade setting up, same stop loss on that trade. So again, I want to get filled before that anchor point low. So even though it's broken down, as it's pulling back up, my worst case fill I want to be up inside of that consolidation low. We had no problem at all hitting our 50 pip target even on the second fill. Obviously the first fill got possibly close to 100 pips, 75 to 100 pips in that range, but this was a great first red day trade. Point I'm emphasizing with these different variations is that don't let the market creep down and trap you lower. We always want to be selling high or buying low. So if we're selling, we want to be selling after the pop-up pulls back inside. Similar on the Japanese yen, we waited for the pop-up and then the rollover back inside. Gain a broken down market that goes vertical through our target, no problem at all. And we'll compare that to the Canadian dollar. Same day, same setups. We have a pump-up day on our Monday. Pink line again represents our Monday. And then we get our first red day on day 2 that closes down at the low of the week. So different variation. This may scare traders, but remember, we're just looking for the setup the next day. No consolidation like on the yen or the Swiss franc, but we have a market that's closed down at the low. I still draw my consolidation highs. That's my box, basically. That's the last peak formations. It dropped down. There's no consolidation straight across, but they go down and they make a low of the day. So the low of the day and the last low of the swing high is my area for high and low. Next day I come to the screen. Same thing applies. We wait for the market to come back inside of our 20 EMA. This is the reverse half Batman pattern. We get our close back inside roughly 16, 17, 15 area. And we get a vertical blow-off move that goes straight down to our 50 pip target, which you'll notice is at the previous day's low level. So if you're a little leery, or example of maybe where it pinned and you didn't have your target exactly where it went to, it might have pinned and your target was there. As soon as that closes with the pin there, I would close the trade. So a difference of about 7 or 8 pips from the 50, but obviously it did hit our 50 pip target. And this volume, this vertical pump up into the high of that consolidation, this little ramp of volume being trapped up high, is a dead giveaway that they are going to potentially go vertical through that all the way straight down. We wait for our close back inside. Even though this is a larger candle, I would still be using a max stop of about 15 pips. I don't worry about how high the candle is because the thesis on this trade is that it should go and explode very fast. Now this is the difference comparing the three. The other two were consolidated. Swiss franc was a beautiful sideways consolidation. The yen was in a consolidation that broke down and then pumped up into that smaller pattern within a pattern. Canadian dollar is in a large consolidation that by all intents and purposes would have people believing this is going to be a vertical long trade, but it comes back inside and blows vertical through the low of the day. So Three comparisons. Again, what I look for out of the three, I always look for one out of the three. Range-bound tight consolidation. This big buildup of this box is a textbook perfect rectangle for an explosive large move. Comparing the different patterns, we have the Japanese yen, we have the Swiss franc, and we have the Canadian dollar. 3 US dollar crosses, all first red day trades, 3 different variations, and we'll look at some other examples of those now. Here's a great example on the euro. We have a Monday and then a Tuesday that ramps up and becomes our pump day. We get our pump day, then the reversal day inside that closes as our first red day. Some traders, you may have other setups that get you into these other trades going long or going short. But the point is we're coming to the screen and we're looking for signal days. And this is one particular trade setup that I look for, first red day. So we get our pump up day. We get our first red day. Pump up day, first red day. We go to we draw our consolidation. I go to bed. For me, this is afternoon when the market closes. So I go through my charts and I just mark off my consolidation, whatever I perceive to be the consolidation. Typically, when the range is stretched out like this, I just find the last peak formations from the session. So that would be our US session peak formation highs right at the open of the 12 candle window. Vertical move, there's our low of day. We'll use the 15-minute chart just to demonstrate the same process applies. We have a market that's gone up and made 3 pushes into the consolidation of the US session before breaking down and closing inside. So again, let's presuppose that some traders have taken this because they're excited and they can't wait. They get in at the close of this first candle that closes down inside. They put their stop up above the high of the day, and that max stop on that particular entry is in the area of, depending on, just assuming you got the worst fill, 99.08, 99.09, stops 15 pips. Our stop is up at the 24.25 level. We put our 50 pip target in, and the market trades down and obviously takes out our target. But if traders heading into the US session were a bit leery, we'll just zoom in on that. If they're a bit leery, thinking that because they're about to open up in the US window, that little bar where it touched our fill, our exit price, again, is an example of where right at the beginning of the US window, if it did not take that out, I'd just close the trade. Whatever, 46 pips, 45 pips, and then possibly take a re-entry when the market continues. Now, that's entirely your choice, but if I come to the screen and I haven't taken the trade, then I'm looking for the pop-up into the trade for the entry back shorter. Now, we'll be using the smaller time frames, but still same process applies. If I get into the market, the trade is already in process from the London session. I'm going to put a 15 pip stop in with that on the smaller time frame and putting my 50 pip target in. Again, it had no problem hitting our target. An example of where these pins went to our target, you might decide that you're going to hold that, walk away, leave it at break even, or when it breaks the low, follow that down on the smaller time frame and lock in is the maximum amount you can on that trade. Obviously, we're on the lower leg of that move, but we haven't broken out of that low. However you choose to manage it, but as it gets to that profit target, if it pins and you hold, the second time it goes down, I'd be closing that trade out. I want to get paid and I want to lock it in. If you want to leave that with your stop at break even, with your profit target intact, that's entirely up to you. But the first red day trade thesis played out again. So an example, we get the pump up day. We'll zoom in again on this pair. We get our pump up day, Tuesday, consolidation up high, and a reversal day that closes as our first red day. Trap volume up high, a breakdown from that rectangle, first red day. We have a triple top. We have our breakdown back inside. Even the first mouse trader has no problem. The second mouse, they can get in same price roughly or just a little worse fill, but it's irrelevant. The trade, once you're back inside, you just want to get filled, put your stop up top, and then put your target in place, lock in the money, and finish for the day. This is a scalable setup. So again, the whole point of this is that it's repeatable. It's a scalable setup. You see it over and over and over again. You can begin to obviously develop the skill and the expertise to read these setups and add size accordingly based on how that market sets up. That Japanese yen example was a classic example of where I would be prepared to put a lot more size in on that trade. We'll look at another example on the euro. We have our Monday goes vertical and closes as our first green day. We have a day two, a second day Tuesday. It closes also as a green day. And then we have a day that collapses on the Wednesday and goes and closes into the low of the session as our first red day. Great example of volume being trapped up high on day two before collapsing on the Wednesday. We go to our close of the session and I mark off my consolidation. Come to the screen the next day and I see a market that's gone vertical, and so I go to my 5-minute chart. Just before we do that though, I want to show traders a peak formation that comes down, another peak formation that comes down, and the third peak formation that comes down and goes into consolidation before this market reverses. So when we come back to the screen the next day, we have a market that has gone one push in the Asian window. We'll mark that off. One push, we've taken out the lower highs, we've broken out of the consolidation. And we have a market now that's gone two pushes in the London session up into the open of the US. So it's continued higher. This pullback does not take out any peak formation highs. So when this market auctions down, which was on news, this is only our second push up. One push, two pushes, and a third push back up into our peak formation, which is a high of the day setup from the New York Open. A little bit later in the session, this is after the New York Open, it goes vertical and pushes up in three pushes to the high of the day before closing back inside. So a little bit longer, but for traders who are trading a little later or different locations, they may have had this marked off on their chart for an opportunity. We have a 15 pip stop. We've got not only the breakout in Asia, we have one push, two push break in structure, and another one push, two push, three push on the third leg. So 1, 2, 1, 2, 3. That's the 33 variation. And we put our 50 pip target in place. The market trades down and hits our 50 pip target. Obviously, traders in the Southern Hemisphere, and that may not have been trading this during the night, but for Northern Hemisphere traders, third hour trade entry as it's getting ready to close the 12 candle window, heading into the new hour, the fourth hour, we get our M structure back inside of the high of the day, inside of the 20 EMA for the 50 pip move back down to the low. So again, first red day setup, a little different variation, but a sell high opportunity back to the low of the session. The high's locked in place. We've got our triple top inside of our high of the day, back inside the EMA, stop loss, profit target, trade, lock it in and get off the screen. One another example on the British pound. And you have to go through as many charts as you can and get familiar with this setup. But we get our pump up day on Friday. Pump up day on Friday, I'm already sort of starting to think that. We get our reversal day, consolidation on the Monday, and first red day on the Monday. So again, a large closing day. Draw my consolidation. High and low of the day going into the close. That's pretty much my last sort of 4-hour window, maybe a little bit less, but that's my peak formation high and low. And then I come to the screen the next day. Again, I can see that they've auctioned higher when I come. So again, thesis being for me in the US session is that I'm looking for the sell high setup, and I have a nice triangle of trap volume. We'll put our 20 EMA on there. And in this particular case, we had a news candle, which I talked about not getting in front of the news, but the opportunity to trade after the news candle. We'll go to our smaller time frame. This is a 1-minute chart. After the news candle, which has the pin on it, I would enter this trade. So after I let that initial volatility spike, whatever, in this particular case, we didn't see a large explosive breakout candle or anything else. I would happily participate in taking a position in this market because, again, my thesis is it's first red day. We're selling the high of the day. We wanted to wait till after the news candle. I can put a 20 pip stop in above the news candle high, roughly 15 to 20 pips depending on where my fill price is, and of course our 50 pip target. The market had no problem hitting our target. Some traders who may have wanted to hold it to the low of the day, the consolidation low, that's entirely your choice, but the original thesis is that this market, we had news on the calendar. Obviously, some traders may have taken the close right on the news candle itself at the pin. Again, giving it a few minutes, the pin hammer is a nice confirmation. Wherever traders want to get in, it's still a max stop at 20 pips because as we see, this trade should explode in the direction of that first red day move. Broken higher through our consolidation. They've trapped volume up high. We had our nice first red day trade for the explosive move back down to the low of the day. This is an example on gold. And gold obviously can have a bit more volatility than the currencies, but the same process applies, and the only difference being is that your stop loss may be a bit larger. So in that particular case, you'll adjust your position sizing accordingly to manage your risk. We get our pump up day on the Monday, the day one. So an example again where we take out the high of the week. We have a market that takes out the high of the previous week on a pump up day. We get a second day that pumps up and goes higher. Closes again as a green day. Puts in a peak formation high, pins up into it with news. And we get a third day, though, now that closes as a first red day. First red day. Now, after the pump up day, because we have 3 days of pump, I will just draw that as my potential area where we have trapped volume up above that level on day 2. That can be our death line, our neckline for a potential first red day trade. Again with gold, same as the other pairs, I just draw my consolidation into the close of the session, and we come back the next day, which obviously in the U.S. Northern Hemisphere is our evening. In the Southern Hemisphere, that would be morning for traders down under. And we have a nice consolidation that narrows into a tighter consolidation into the open of the Asian session. This is on the backside of our move from a 3-day pump up. So this was an excellent opportunity in the Asian session for traders to be able to take this trade in the Asian 12 candle window. So either getting in on the pop up, getting in underneath. Again, it doesn't matter. Once the thesis is starting to play out, I will get into the market. I will put my stop loss in place. 20 pip max stop even on a bad fill. That's my maximum stop, which takes us right back to the high of that beginning of that pop-up at the beginning of the 12 candle window. This trade had no problem hitting our 50 pip target, but in a situation again where I get a consolidation, a real tight rectangular consolidation, I will often look for one full expansion of that range, my last high and my low of the session, that consolidation. So I'll take the high of the Asian session, the low of that box, and I'll look for one full expansion potentially, which takes us to the low of the day, or a second full expansion of that range in an explosive market. So you can see this market just continue to fall. We don't have a lot of back and forth lower peak formations. This market just falls and keeps flowing through the low and completes a target of over 100 pips. First red day trade for Asia on gold. Excellent opportunity. Another example on gold, we have our pump up day, a market that goes vertical and then closes as an up day. We get a day 2, a second day that pumps up through the high of the pump up day and closes again as a green day before breaking down and closing as our first red day. So again, first red day, we have our pump up day, we have our peak formation day possibly, and then a first red day. So the process is pump up day, first red day. We have a 3-day setup. We go and draw our lines heading into the close of the day, our consolidation high-low. Again, I'm trading the U.S. session, but we may see an opportunity in Asia. We may see an opportunity in London. Sometimes, like we saw in the Asian example, we can see a massive vertical move when we have the 3-day pump up tight and a small subtle variation of the first red day for a vertical blow-off move. The process is the same. I come to the screen, I put my 20 EMA on, and depending on the session that you're trading, some traders again may have gotten in the Asian session thinking that this was about to accelerate down. When we see that creeping trend down and it's not playing out, you can either cut the trade, you can hold on to the trade, whatever that decision is that you make. The luxury that I have in the US session is that by the time I come to the screen, I'm looking that all the information is on the board. Now, sometimes I'm going to miss out on some of the big moves that happen, as I said before, in Asia or London. But if you're in a trade like this and you get in Asia and we have 3 pushes, I would be looking at cutting the trade and recognizing that we may get another opportunity in the Europe-London window rather than hold on to that. The first red day, the ideal first red day when we get a nice consolidation and they hold 3 sessions into the high of the day heading into the U.S., that is a sizable first red day opportunity. When they break down prior, we may get a sizable opportunity in the Europe-London window, or like we saw in Asia, we had a nice tight consolidation, a rectangle range. Now we have a rectangle range, but we don't have a smaller rectangle within a pattern. We have a 3-push pattern that breaks down. We have our entry back inside of the 20 EMA. But when we see these 3 pushes and the trade does not break down as it should, again, I'd either cut the trade or close it out. You're not going to get stopped out down here, but if it's got 3 pushes and it hasn't blown off or hasn't broken right down towards the low, then I'd be suspicious about closing that trade. But we get a nice pop-up, a 3-push pattern heading into our Europe-London window. And again, there is an example of where I will get into the market based on the timing window inside prior to the breakthrough of the low. So again, our Europe window has now opened. We've popped up, traded back above and broken down. So this is prior to our 2 a.m. window for Europe-London traders. Once that 9 a.m. window, 1:45 a.m., 2 a.m. New York window starts, or just a few minutes prior, I will position myself in the market. And again, the same rules apply. This is gold. Peak formation high is my stop loss. In this particular case, the stop is at 32. My entry roughly is going to be somewhere around that 7, 8 area, 7, 8, 9, 10. So we're talking about a 20 pip stop. That's my max stop on this pair. The market collapses and hits our 50 pip target. Continues to go lower, so again, an example of where you can take the bulk of the position off if you think that the market has more steam in it. I would take 75 to 80% of the position off, or maybe even 90%, and leave a small trailer to potentially lock in a bit more, especially as it's a Monday and we're still heading down. We had a nice breakdown collapse, which means the market is still expanding the range on day 1 on the Monday. First red day, obviously the trader who was in Asia, if he stayed in that trade, no problem. He just had to sit through a few more hours before the market finally collapsed. But the Europe-London window gave us our 50 pips over very fast, no stress trade. Another example of a market that goes vertical on gold, pumps up, continues to go higher the following day, trading through the high of the day. So we pump it up from the low of the day. The market continues to go higher before breaking down and closing as a first red day. Draw my consolidation so that I can come back the next morning and take a look at where that market is traded inside or outside of that consolidation. Now, when I come to the screen, the market has not broken out of that consolidation or given us a peak formation high or low until we come to that Europe open window. This is an example of where, we'll just zoom out a bit here, draw our box. The market trades right back to the high of our consolidation, before breaking back down inside. So there's our peak formation stop hunt. It breaks back down inside of our 20 EMA. So again, just removing our analysis paralysis. We'll even take a first mouse trade entry for anxious traders. So again, nothing wrong with taking an entry underneath, giving that consolidation a few bars and taking the trade underneath as it breaks down. Or if you're getting in right away because you're afraid it's going to take off without you, that's okay too. We can get in, we take our trade, our stop is still going to be at the high of that bar. And in this particular case, our stop roughly, we're filled at around 09, 010. We're looking at a 20 pip stop as our max stop. The thesis always is that once they've gone up and broken down, that they're done doing their work up there. They've cleaned out stops, they've triggered breakouts. We have our stop loss in place. If we were to enter the market down here, the same process would apply. If I was to be filled at the break of this bull candle, we're filled at roughly 2, 3. Put our 50 pip target in place, and the market had no problem hitting that target, which was basically at the low of our consolidation. So an example of where traders may have held on for more, this comes back quite a bit into your position, which is why I always emphasize locking in a profit and mastering taking the 50 pips. You know, after a while, you'll start to recognize that potentially you can re-enter a trade, or you can hold on certain setups for an explosive move that's going to continue. But in the beginning, I emphasize the process. The process. We had our consolidation. We had our first red day. We had our consolidation. We had our peak formation high stop hunt in the Europe window. We had the reclaim of the 20 EMA, which again just helps us remove any analysis paralysis, making this as simple as possible. We had our max stop of 20 pips on this pair. And obviously, as you get more skilled at this, you could probably tighten your stops up even more depending on the instrument that you're trading. But in this particular case, with gold and oil, 15 to 20 pips, 15 may be a bit tight, but 20 should be fine, especially once it comes back inside. This market should move very quickly. And in this particular case, again, we had a nice clean cut rectangle. If I was going to leave a trailer on, I would be looking at a full 100% expansion of that range. When it's a very crisp, clean rectangle, I'll look for one expansion of the range for the measured move as a potential profit target, which in this case it did hit. So 100 pip move, and mastering that first 50 pips, take 90% off, 75 to 80% off, leave a trailer in, and make sure that you lock in profits as it's falling. If it was to hesitate or anything else, that takes us down into the open of the U.S. session. So excellent first red day trade on gold. Now, ideally, the first red day setup, we're going to have a consolidation heading into the close of the session. When the new day starts trading, what ideally I want to see, for me being in the Northern Hemisphere, is a market that builds up over the day towards the top of that consolidation to give me my entry up high for the big explosive first red day opportunity. That to me is the ideal best first red day trade setup. Now, there are going to be other cases where we can get a move up in Asia. We can get a large move down in Asia that when I come to the screen later, Europe, London may have a continuation, but when I come to the screen, the opportunity may be gone. Now, the other scenario is that we can also have a market that trades in the, I'll just change that, in the London session for a large move down, and I get the low-hanging fruit trade in the US session that finishes off the move. But just to repeat, the ideal candidate, the best candidate, will be one that builds up over the course of the day, 3 sessions, and we get a large capitulation that will often now give us our measured move distance of at least one full expansion, or maybe two or three, but hopefully two. If it's a really good first red day, we'll get at least a 2 times expansion of that high-low rectangle, which typically will be sort of in the area of 100 pips, depending on the instrument. Now, gold and oil may be more, but when it's a really well-structured rectangle on a first red day setup that gives 3 sessions and builds up volume, we can get an explosive, all-in, perfect first red day trade setup. We can look at an example on oil. We get a nice big vertical pump up on the Friday. For our pump up day from the low of the week on Thursday. On the Monday, we then get a day that reverses and collapses back down, forming our first red day. We have our pump up day and we have our first red day. So again, the end of my day, I will typically just draw my consolidation, which is the most recent swing high, swing low consolidation, and come back the next day and take a look at the chart. Now, if you're trading in Asia or London, obviously that consolidation may have a setup for your session, and we'll look at an example of that with the London window. I go to my 5-minute chart and my 5-minute EMA. I have my high-low consolidation. The market went up in Asia and put in a peak formation high before auctioning back down, which again is not a trade setup. We're establishing a high and low. So traders who take that, take it with the understanding that if you were in this market and it trades down to the low, you either have to lock in that profit, go to break even, or just cut the trade. But once it auctions back down, so for example, trader may have taken this trade entry on the close back inside, and let's say we have our stop on the poor fill at 48. Our stop loss would be at 68. That's our max stop loss, 68. That market then proceeded to auction down to 07. So it hit our 50 pip target. Took a little bit in terms of time to get there. No reason why you couldn't have taken that, but again, we're looking for that nice big rectangle to build over some time. So for traders who, if they identified this as their rectangle, we had our pop-up stop hunt that broke back down inside. You put your stop loss in place, you put your 50 pip target in place, which in this particular case was right here. Our 50 pip profit target is hit. We then go back to our Europe-London time window. Same thing happens. We have a market that pops up into our high of the day before breaking down back inside towards the end of our first hour in the Europe window. We have a market now that's collapsed inside. Again, traders, once it's back inside, even if we get filled down here on this collapsing candle, the process remains the same. I'm filled at 28. My stop is at 48. Now, I would be getting filled sometimes even up underneath of that peak formation, but once it comes back inside of our EMA, I want to get filled at best price as soon as possible, and my stop loss will go back above that peak formation high. We then can look at this and we have a larger structure now. We have a nice geometrical rectangle where I can hypothesize that we have the potential to do a full measured move of that range. Oil is a fairly explosive market. We have a first red day opportunity in the Europe window right at the open of the London session. The market completes that move for 100 pips plus. But the other scenario is you take your 50 pips, you leave a trailer with your position at break even once this market collapses, and you can target that second full expansion, or even on a smaller time frame, follow this down to lock in the maximum amount on that winning trade. So we have an Asian session trade. Wouldn't call that the ideal because, again, we want to build up a box, a nice rectangle, but the first red day trade played out. We closed back inside of the 5 EMA. I'm using different examples so that when traders who are learning are going to make some judgment errors, the number one thing is that you manage the downside. You lock your stop in place. You put your profit target in place to make sure you lock in your 50 pips. Master taking the 50 pips. As time goes on and you get better at recognizing the larger opportunities, then you can look at taking the larger amount off or leaving a trailer in or holding on for the full amount. But in the beginning, I would certainly suggest mastering taking the 50 pips and locking in that money, walking away from the screen, coming back later, reviewing the trade setup, the timings, what you did well, what you could have done better. But we had our first red day opportunity. We had our consolidation. We had our pop-up peak formation that failed, came back inside of our EMA, gave us our entry. We put our stop in place and a profit target. It was hit. We had a second opportunity in the Europe-London window. Pop-up, hitting stops, breaking down, collapsing back inside. We had our 1-bar stop. We had our 50 pip target and a trailer potentially for a measured move of a geometrical breakout of a rectangular structure. Look at another example on the S&P. We had a large pump-up day on news that continued to go higher into the end of the week. We had a market again that popped up, and we had a first red day close on the Monday. We go to the 15-minute chart, and we don't really have a consolidation. We have a high and a low. And you'll notice the difference from the other charts where we had a well-defined consolidation. We come to the screen the next day, and we have a market that's gradually just kept working its way higher before going vertical. Now, obviously, we had a sell high setup for traders who wanted to sell the high on the half Batman, but our first red day did not pan out to give us an actual setup on the day. We follow that market across, and we get another red day the following day, which is also an inside bar. So we have a first red day on the Monday that pumps up towards the end of the day and then drops and closes as a first red day before going vertical and pumping up again and collapsing. And then the following day is an inside bar that gives us our first red day trade. We have a high and a low where we can draw our consolidation. The whole point of the high and the low and the consolidation is that we want to know that we're potentially inside a volume that could be caught if this market was to collapse. We come back the next day. We go to our screen. We put our 5-minute chart up. And we have an opportunity where traders may have shorted this in the Asian session. Again, we can narrow our 5-minute consolidation down a bit tighter. And not an ideal situation. I look to only mainly ever trade the indexes in the U.S. session, but we will see that there are opportunities that will show up in all sessions. So we have our market that pops up, takes out the high, and if traders were to short this on the bear pin hammer back inside of the 20 EMA, we put our 20 pip stop in. It's basically a 1-bar stop. The market proceeds to auction down and doesn't quite get to our target. Little bar and a pop-up, I would cut this trade. So we have our 1-bar stop, market comes down and 3 pushes. We get a little bar right without taking out the low of our stop. So again, understanding taking the trade on the S&P in Asia sometimes may not be the best timing, but just following the process. An ideal first red day is going to give us a larger consolidation box buildup that pops the top and then breaks down from there. We come back later for the Europe-London window and we get our 3 pushes into the high at the London Open before breaking down, and we get the same type of entry with our bear pin hammer after the London market has opened. So again, the importance of understanding the equity sessions. We get our entry